Hello, I'm Brett Lewis, the founder and managing director of Strong Tower Wealth Management. The fact that you're viewing this video means that you're wanting to get a better understanding of what we at Strong Tower do for our clients and how we may be a resource for you and your family. We're not going to use actors, fancy production, or overblown graphics. We're going to have a simple conversation. Now, the most important aspect of this conversation is you. Maybe you're new to investing. Maybe you're approaching retirement or in retirement and looking to entrust someone with those assets. Perhaps you're currently investing, and if you are you willing to look under the hood to see what you're currently doing, understand what you're invested in, what those investments are costing, what the risks are with those investments? We're going to discuss who we are, what we do, and what we do not do. One of the reasons we launched Strong Tower Wealth Management after 22 years of working for other companies and other companies telling us what to buy or sell or use their certain research departments. We did this because, again, we felt there was a better way. Strong Tower Wealth Management is a full-service, comprehensive wealth and asset management firm. We manage 3 portfolios: growth and income, and aggressive growth where appropriate. We are fee-only advisors. As a fee-only asset manager, we are typically less expensive than other firms in the fees that they charge. We are engaged in the daily direct management of our clients' accounts. We do the research, we determine the allocations. We determine how conservative or aggressive to be in the market based upon market conditions. We are the decision makers on the account. We are constantly reviewing your positions, and we do that on a daily basis. And we do that by keeping a manageable number of positions in your account and in our models. At Strong Tower Wealth Management, we manage the assets in-house. We also have complete fee transparency. We only charge an external fee to our clients. There are no internal fees. Other firms have internal management fees on their investments. At Strong Tower Wealth Management, our goal is simple. We always want to make sure that our clients own the best of class, the strongest stocks in the market. Yes, that leadership changes from time to time, sometimes very aggressively. Market volatility increases, so we have to move a little quicker. When we have increased times of volatility, then raising cash and being defensive becomes even more important. I say that because I'm reviewing every position we own within our 3 models every single day. I'm looking for other areas of opportunity. I'm looking for leadership changes. In our opinion, if you're not managing the positions in your portfolio properly, then you're going to have difficulty reaching your retirement asset goal. We do not outsource your investment management to someone else, to a research department, or to a money manager. We do not believe that buy and hold will ultimately provide the solutions for your retirement assets. We don't set it and forget it and hope it works out. And we do not believe in passive management strategies. We do believe in asset allocation as a vital part of investing your money. But, however, you can be over-diversified. You can be in areas of the market that are losing money. And we would prefer to take that money and overweight it to a stronger area of the market. So by being over-diversified, you can actually cannibalize your investment returns. Charting an appropriate investment strategy in today's investment environment is getting increasingly difficult, mainly due to inappropriate risk management and defensive strategies within your account, and also lack of qualified investment advice. This industry has become very commoditized over the last several years. Companies have discouraged their advisors from doing research or their own due diligence to determine if a position or a group of investments need to be put into a client's account. So it actually minimizes the involvement of the advisor really within your accounts, in your portfolios. My question is, if it's being managed by someone else, why are you paying for that advice? You can go do that somewhere else for free, because in the absence of value, price is the only consideration. Everyone talks about process and how their process is better than the other person's. But when it comes right down to it, in the final investment selection, it's typically a group of mutual funds. And those mutual funds are either managed by the firm or by someone else. In other words, your money's outsourced. There is a difference. Do they mention exit strategies or defensive measures in your account when the market volatility increases? If you don't hear the terms defensive measures and exit strategies, you're not getting any. We utilize relative strength investing. Others in the business refer to this as momentum. Simply put, we want to own the strongest areas of the market and avoid the weaker areas. If we don't invest in the weaker areas and allocate that money or overweight that money to the stronger areas, it would stand to reason that our returns should be better. For example, you're the owner of the baseball team, and my job is to put a competitive team on the field. If we keep the same players year in and year out, they will get older, slower, and probably don't compete quite as well. But if we draft, if we trade, if we upgrade our lineup from time to time, we will be pretty competitive. Your money should be invested the same way. Also, as the owner of the baseball team, do you allocate your money to the role players or the better players with the more positive attributes? We will allocate money to the stronger players in the strongest areas of the market. We do have other, again, allocations, but we don't overweight in those areas until they prove to be in a leadership position. We also focus on sector rotation. Areas of the market rotate in and out of favor. So, as the leadership changes, we make adjustments, tweak your account, or weed the garden, if you will, of areas of underperformance. Own the leadership, sell the laggers. This allows us to always own the best of class. We also utilize fundamental and technical analysis. Fundamentals tell us what we want to own. Technicals provide us a way to evaluate at what price or when we want to own them. So by utilizing the two together, we feel like we can make a better decision for our clients. There's times that we focus on wealth accumulation, making money while the trends are favorable. And there's times we need to focus on wealth preservation, raising some cash, getting rid of some underperforming positions. In other words, being a little bit defensive when necessary. Keep in mind, regardless of the volatility of the stock market, there is a bull market somewhere. You just have to be willing to look for it. Favored sectors. That simply means that money's flowing into this particular area of the market. More stocks in that sector are on buy signals than sell signals. And when more than 50% of that sector of the market is on a buy signal, then it becomes a favored sector. When stocks are being bought, it pushes prices up. Therefore, you're in a favored sector of the market. Also, demand is in control. Consider the reverse. If it's an unfavored area of the market, money's flowing out or positions are being sold. When stocks are falling, that means supply is in control. And folks, supply-demand relationships are real simple. Whether you're talking about a stock, a gallon of milk, or a gallon of gas, price is the true determination of what a stock is worth. One of the most popular and widely accepted and utilized investment strategies today are mutual funds. Does your current advisor have a manageable process for managing multiple positions in your portfolio? Stay with me on this. Most mutual fund portfolios have, say, 10 individual mutual funds. And each one of those mutual funds has 100 to 150 stocks. So in all total, there's over 1,500 stock positions within that model. There's no way anyone's going to be monitoring 1,500 stocks on a daily basis. We also utilize exit strategies. At Strong Tower Wealth Management, this is one of the cornerstones of our process. Exit strategies allow us to raise cash, be defensive, put the money on the sidelines if need be until the dust settles. Then have an entry strategy to deploy the money at appropriate times or at least at undervalued opportunities in the market. We believe the utilization of cash as an asset class is vital to lowering the risk in our clients' accounts. There are many pitfalls to investing money. Let's discuss a few of the more popular ones. Modern portfolio theory, or also referred to as MPT. Modern portfolio theory is just a simple assumption that there is a constant efficiencies in the market. And I will go through some examples that the market was highly inefficient. One of the most popular investment strategies working toward retirement or in retirement are mutual funds. You can actually be over-diversified to the point of mediocrity. At Strong Tower Wealth Management, we prefer to own only 30 to 40 individual stock positions within your account. Strong Tower does not own bond funds. We are in equities or cash. Also, there's interest rate risk with bond funds. Well, what does that mean? Well, to keep it simple, interest rates operate on a teeter-totter. As rates have fallen, bond prices have appreciated. So the value of your bonds in your portfolio have probably shown a gain. As rates rise, the value of those bonds will decline. So the idea of being more diversified or allocated or maybe a more conservative portfolio by owning bonds can still be at risk because it's actually losing money while your equity portion of your portfolio is trying to make you money. Let's discuss bond funds. The drawback to owning bonds is the fact that they're not even paying enough to keep up the rate of inflation, but yet they're considered less risky. So my point is, while it may be considered diversified, while it may be optimized and it may be appropriate based upon your risk tolerance, the bond allocation can actually be costing you money or performance when you're trying to make money on the equity side. Are you truly aware of the risk associated with your bond funds or fixed income investments within your portfolio? Other options that I have run across in retirement planning are target date funds. The perception of less risk with your money being allocated more toward bonds as you get closer to retirement than in equities. Strong Tower Wealth Management does not own target date funds. The only determination of a client regarding a target date fund is their age, nothing else. Another pitfall of my industry is lack of appropriate exit strategies within your portfolio. Have you ever noticed on your statement that you may have a few positions, maybe one or two, that are really underperforming and underperforming very poorly? Why do you still own them? Why have they not been sold or replaced with something else? Let's discuss non-correlated assets. Well, non-correlated means that they're not related to each other. And if one area of the market does well, the other areas of the pie chart or that allocation don't do as well. In your typical asset allocation model of mutual funds, you're going to have equities, bonds, or fixed income, and you're going to have international and commodities, maybe even some currency exposure. The point is, it is a broad-based approach with a little bit of everything. So the problem with non-correlated assets is that in times of increased market volatility, those non-correlated assets become correlated and in an exponential fashion. So in times of extreme downside volatility, when you need it most, that allocation strategy will fail you also. Let's discuss rebalancing. Well, what is rebalancing? Rebalancing happens when a client brings money into a firm and that money is rebalanced or allocated to a particular model. Well, Strong Tower Wealth Management does not believe in rebalancing. Why? It depends on the level of the markets. Now stay with me on this. If the markets are elevated or overbought or reaching all-time highs, why would you want to put your money in, fully invested, rebalanced at the top of the market? We don't think you should. We don't rebalance to the model regardless of market conditions. We deploy your money very specifically depending on those market levels and conditions. Also, if you're getting a rebalanced strategy or you're being rebalanced to the market, you're getting nothing specialized. Again, your money's going in and buying these stocks or these mutual funds that have been in a bull market for 10 years at elevated levels. At Strong Tower, we determine what the overall risk factor is in the markets. And if we determine that the markets are a little overbought, then we're going to be conservatively putting your money in at that market. And we're deploying your money individually. Eventually, yes, you will look like everyone else in the model over time, but on the front end, your money's deployed very specifically, either aggressively at the bottoms or conservatively at the top. What's your investment strategy? While no one can predict the market, do you currently have a process in place, or does your advisor have a process in place that can navigate these type of market conditions? What will they do different the next time? Let Strong Tower Wealth Management review what you're currently doing. Let's see how your investments lay out. Let's see where you're overweighted or underweighted. Let's see where the true momentum and relative strength is in your portfolio. The results may surprise you.